The Bank of Canada left its overnight interest rate unchanged at 2.25% after 6 consecutive cuts. Joining me now to discuss the latest decision is Francis Fong, senior economist at TD Bank Group. And Francis, what's your reaction to the decision? Any surprises here?
Thanks for having me, Anthony. So yeah, no real surprises here. I think it was widely expected that the bank was going to leave rates unchanged. I think what's key here, though, is to look at the monetary policy report that they released alongside their rate decision to see how their view of the outlook has evolved, over the past few months. And there, also, no surprises as well. I think overall the Canadian economy has shown more resilience than we would have given it credit for about a year ago. A lot of the main indicators are sort of showing signs of, one, resilience, and then two, things heading in the right direction. So inflation, it's still elevated, but the core measures are moving in the right direction, with 2 of the 3 core CPI measures heading closer and closer to that 2% target. So that's a positive. If we look at things like trade and the labor market, again, as to be expected, there's a lot of weakness there, but again, we're still seeing more resilience than we would have given it credit for a year ago.
So given the resilience in the economy, do you think the Bank of Canada is likely to keep interest rates on hold for the rest of the year, or could we even potentially see a rate hike at some point?
Yeah, so the rate hike conversation has been quite strong in recent months, and I think that's a lot of it is due to the way the inflation numbers have evolved over the last few months. We've seen things like food inflation come up quite a bit, and that's being driven by all sorts of factors: trade and tariffs, climate change leading to droughts all across the world, and things of that nature. So we're seeing things like beef prices really high, coffee prices really high. We're still seeing rent inflation to be quite sticky, but if we look through those things, and this is sort of what the Bank of Canada is likely to do, they'll look through these transitional factors. If we look at some of these core measures or factors that were contributing to high inflation previously, things like owned accommodation inflation and a lot of the core measures, they are headed in that right direction. So we don't think that the hike conversation is really justified, especially when we're anticipating that growth is likely to remain weak over the medium term. So we have the bank sort of staying pat for the remainder of the year.
All right. Now, the big question, of course, remains tariffs and the lack of a deal with the United States. What happens if we don't reach a deal, and what could that mean for monetary policy going forward?
Yeah, this is a tough question to answer. Obviously, the geopolitical situation is quite volatile. We just saw Trump sort of announce or a new threat around a new 100% tariff, which remains to be seen whether it will actually get implemented. The important thing here, I think, is to sort of look through all of this to see what's actually in place today. And if you look at what's been announced versus what the actual effective tariff rate is, it's quite a bit lower than what's actually been announced. The effective tariff rate, according to the Bank of Canada, that they've assessed is the amount of duties that are being collected by the U.S. on Canadian exports is actually around 6%. And the effective tariff rate that Canada is applying to the U.S. is about 1%. So beyond all of the talk about it, the actual effective tariff rate is quite a bit lower. Now, if we're there to be a trade deal, a new USMCA, it's being renegotiated this year. The U.S. is likely to trigger that renegotiation early. All of that would alleviate a lot of this uncertainty that we're facing. So for the time being, I think we just have to sort of wait and see what actually comes out of these negotiations. But if we look at the underlying sort of trend, we're not seeing trade decline by quite as much as, again, we thought it would, given the bluster around high tariff rates. And there's a lot of contributing factors to that. One is the tariff rate, the effective tariff rate that I mentioned earlier. But we're seeing a lot of policy decisions from government to move beyond that. We're seeing diversification of trade away from the U.S. to our other trading partners, and we're seeing some benefits from things like commodity markets, where gold and silver prices, Canada mines quite a bit of that, is actually contributing to a significant increase in precious metal exports, which is offsetting some of the sort of negative impacts faced by steel and aluminum, autos, and things of that nature. So there's things to remain positive about, but obviously the uncertainty is going to be a huge factor.
All right. Now, let's talk a little bit about the U.S. dollar, because it has had a pretty rough start against a basket of currencies. Do you think we could see more upside for the loonie going forward?
Yeah, and this is where those geopolitical risks and some of the chaos coming from the Trump administration really playing out. This sort of broad U.S. dollar weakness, that's been a story for the last 12 months or so. And the Canadian dollar, despite being sort of right in the line of sight from the U.S. administration, it has sort of benefited from that. We've seen the U.S. dollar weaken quite significantly against the euro, about 14% against the euro, about 10% against the pound, similar against the Swiss franc, and so the Canadian dollar is up about 4% over the past year, which is sort of helping to sort of cushion some of that blow. And then we do anticipate that sort of broad strengthening against the U.S. dollar from all currencies to sort of continue on. So, it's at about 72 cents right now, and we're anticipating about 75 cents by the end of the year.
All right. Now, finally, given all that, we've got a resilient economy. What key indicators will you be watching closely over the next few months?
Yeah, Anthony, is it a little glib to say everything? Because unfortunately, we're looking at everything. Like, we have to look at, how the inflation data evolves, how much pass-through is going to come through on tariffs, how much resilience is the labor market showing, what's happening with trade, these trade deals, geopolitical risks, all of that. There's a lot going on. And unfortunately, every single one of those factors could contribute to weakening of the economy, something happening with inflation and financial risks as well. We saw the Japanese bond market sort of implode. That had knock-on effects to the rest of the economy. All of those things are, high equity valuations are also a significant risk going forward. All of these things are contributing to our outlook. And so it's unfortunate, but it is something that we have to look at.